Hey, good morning, everybody. Good Tuesday morning. Good to see you. It's November 7th, Election Day. If you haven't voted, make sure you go out and vote, whomever you're voting for. And it's Tuesday, so it's time for our Tuesday weekly webinar. Good to see everybody. And for those of you who are just listening, I don't know what you say, but thank you for listening. But good to see everybody, and I hope you had a great weekend. Really, really beautiful weekend here in southeastern Pennsylvania, and I hope it was beautiful where you are too. I'm going to go over the format for our weekly webinar, and if you haven't already, and if you're just joining us on YouTube, you can hit the subscribe, like, and notification button, and you'll be sure to receive all of our updates. You may have questions as we go through this webinar, and you can always reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. And that reaches the entire team. So whomever is best to answer that question, whether it's me, one of our planners, or someone else on our team, that one of us will reach out to you. And if you want to schedule time with me to talk about your specific strategy, you can also do so by emailing us at questions@attleborowealth.com. If you happen to go onto our website and there is an online calendar, sometimes we do some time blocking and things like that to work on projects and follow up for clients. But if you want to, if you can't find a time that works on the calendar, again, be sure to reach out to us at questions@attleborowealth.com, and we'll make sure to make time for you so we can answer those questions and make time to see. And if you're a client, obviously reach out to us at admin@attleborowealth.com or questions@attleborowealth.com. They both go to the same, or to Jessica, and she can schedule time with you immediately. Okay, so let's get into our format. That's not what I wanted. Let's get into our format. And today we're going to go through the weekly webinar series. So we're going to talk about slot updates and maybe some headlines. And then we're going to talk about the markets. And boy, what a market last week, in a good way, right? And I'm going to discuss it a bit. But if there was ever a reinforcement of not trying to time the markets, the week ending, or the week, what was that, November 3rd, the week ending November 3rd was a very good illustration for why you should not try to time the markets. But we're going to talk more about that. So we're going to spend first 15 minutes or so during my doing the Ed Slott group updates, and I've got some good ones. I might not get through them all. I have so much material from the classes I did last week, my training classes. I do training classes for you folks, but I also take training classes. So last week, all day Thursday and all day Friday, I was strapped to my desk because I couldn't go away because we had these pop-up questions for continuing education for my certified financial planner designation. We had these pop-up polling questions that you had to answer, or you don't get the credit for sitting there in front of your screen. So I was strapped to my desk and/or carrying my tablet around so I wouldn't miss it, listening to all these great updates from the Ed Slott group and great comments and questions from people all around the country. There's only 400 of us in this group, maybe a little bit more than that, and some of the brightest minds that I've ever seen are out there. So so I'm going to have a lot of good material coming out of those classes, like I typically do, to share with you. And then we're going to talk about market updates, and then we're going to go into our financial planning segment, what we call our Financial 15. And this segment is called year-end planning. So here we are, November 7th. It's the end of the year. The end of the year is going to be on top of us really, really quickly. We need to have things done like Roth conversions and other things completed by mid-December, and then we close out the year. This office is closed for the week between Christmas and New Year's. So if you need something before then, or you think you might need something during that time, and somebody always needs money during that time, but that's okay. Our office manager, Jessica, checks in most days during that week just to make sure that our clients are taken care of when we're completely shut down for the week. So we'll make sure that we're on top of that for you. But if it's something we can plan for ahead of time, that would be great. So let's make sure I didn't miss anything, and let's get into it. All right, I'm going to share my screen here. So here we are. So you might have heard about this already, but there's been some updates for the contribution limits for both 401k plans, retirement plans, 403bs, 457 plans, etc., and IRAs. So let's first start with IRAs because Sarah Brenner wrote a nice piece about this last Wednesday. And Sarah writes, the IRS released cost of living adjustments, that's COLAs, for 2024. Many IRA limits will increase next year. So the IRA contributions, the limit on annual contributions to an IRA is increased from $7,000 for 2024 up from $6,500 for 2023. The IRA catch-up contribution limit for individuals age 50 and over was changed now to include a COLA under the Secure 2.0, but remains $1,000 for 2024. This would allow an individual who is age 50 or older in 2024 to contribute $8,000 to an IRA. Some new additional COLAs for IRAs for 2024 made under the Secure Act are as follows. The limitation on contributions for qualifying longevity annuity contracts, or QLACs, was raised by Secure 2.0 to $200,000 for 2024. This limit remains $200,000. For the first-time qualified charitable distributions are indexed for inflation for 2024. The QCD limit is increased to $105,000 per person, up from $100,000 in 2023. The limit for a one-time QCD from an IRA to a split interest entity is increased to $53,000 for 2024, up from $50,000 for 2023. We spent a lot of time on that split interest entity issue, and there's a lot of confusion between the one-time QCD as opposed to an annual QCD. So if you have questions about that, reach out to me because I know it's confusing. A lot of the new Secure Act and the even things still out of the old Secure Act are very, very confusing. The Congress does a good job of continuing to make the tax code confusing. So other IRA COLAs, the income ranges for determining eligibility to make deductible contributions to traditional IRAs, to contribute to Roth IRAs, and to claim the Savers Credit all increased for 2024. The deduction for taxpayers making contributions to a traditional IRA is phased out for single individuals who are active participants in an employer plan and have adjusted gross income between $77,000 and $87,000. This increased from between $73,000 and $83,000 for married couples filing jointly. If the spouse who makes the IRA contribution is an active participant, the income phase-out range is between $123,000 and $143,000, increased from between $116,000 and $136,000. For an individual who is not an active participant but is married to someone who is an active participant, the deduction is phased out if the couple's income is between $230,000 and $240,000, increased from between $218,000 and $228,000. So again, if it's not confusing yet, it may get confusing soon. The income limit for the Savers Credit is $76,500 for married couples filing jointly, up from $73,000, and $38,250 for singles and married individuals filing separately, up from $36,500. Now listen, if you're listening to this or trying to take notes on this, of course you're going to get a recording of this like I always do. I send out a recording usually on the weekends. Good morning, Keith. Usually on the weekends, I send that recording out, so it gives you something to listen to while you're having your coffee on a Sunday morning. But we'll get updated charts and we'll upload those onto our website as soon as they're available. Well, we usually wait until about April, the end of March, the beginning of April, to update for our new tax charts, because people are still doing some of their tax. Not tax planning, but not after the beginning of the year, but the tax preparation, and they rely on those charts. So I've learned over the years to keep the old ones up until about March, and then we update them in about April. So the SEP contribution limit for 2024 is 25% of up to $345,000 of compensation, limited to a maximum annual contribution of $69,000. The SEP is a really good vehicle for putting a bunch of money aside every year, but it can be, if you have employees, it can be a little challenging. But don't forget, under the new SEP, Secure 2.0, SEPs can now be Roth. Prior to that, there was not an option for a SEP Roth IRA, but now we can do Roth contributions, just like simple IRAs now can also be Roth. The maximum simple IRA elective deferral is increased to $16,000 in 2024, up from $15,500 in 2023. The catch-up contribution limit for simple IRAs remains at $3,500. More information on these and other colors for retirement accounts for 2024 can be found in Notice 2023-75. That's IRS Notice 2023-75. So you'll see that I put another note here that is kind of outside, if you're watching, and that's outside of the format of Sarah's letter. And this has to do with elective deferrals for 401k plans, 403b plans, and most 457 plans. And the government's thrift savings plan. Those elective deferral limits will increase from $22,500 to $23,000. The catch-up contribution for those 50 and over remains unchanged at $7,500. That makes the total contribution limit for those accounts, these types of accounts, and those folks over age 50 increase to $30,500. So just a $500 increase to contribution levels, but we'll take everything we can get. All right, I'm going to come back to this Secure 2.0 biggest mess. Let me see. I'm going to check time on that. Yeah, okay. I guess we're going to do that one. I guess what I did when I put these together was I usually do the Slott report mailbag. I like the questions and answer. But this is so important, this Section 327 that came out of the Secure 2.0. Now, I'll tell you, this is very, very... what's the word? Technical. It's very technical, but it's something that I want you, as my dedicated listeners who listen to these webinars and watch these webinars, it's something that we want to start talking about, because I want you to be aware of it. Because if someone, many of you are over the age that this will really have a big effect on you, but there are people that first of all, you might be under 59 and a half and over the age is 59 and a half. You might be under 59 and a half, and this could greatly affect you. Or there may be somebody close to you who this could affect. So we're going to talk about inherited IRAs and particularly spouses in this section. But we spent a good amount of time. I don't know how much time it was on Thursday or Friday during the webinar for the Slott training, and that's the last one we're going to have. The rest of the trainings are going to be live, thankfully. But let's get into this, and you'll see what I mean. So this is by Ian Berger, and Ian is very, very technical, which is good. We've got some really good technical analysts and advisors from the Slott group. But Ian writes, of the 92 provisions in the Secure 2.0 legislation signed into law last December, by far the most challenging is Section 327. Section 327 changes the distribution rules for spouse beneficiaries of IRA and workplace plan account holders and is effective January 1st, 2024. So really, really soon. It's hard to know exactly what Congress was trying to accomplish with Section 327. Some commentators believe it was designed simply to create more favorable distribution rules when a surviving spouse inherits from a younger IRA owner. Fair enough, but if that's what Congress was trying to do, the drafters of the new law totally messed up. Congress should have simply layered the new rules for older spouse beneficiaries on top of the existing rules that would continue to apply for all other spouse beneficiaries. Instead, Congress completely removed the existing rules and substituted a brand new set of complicated rules that will apply to all spouse beneficiaries. The result is that some of these beneficiaries will actually be in a worse position than they are under the current rules. That couldn't have been what Congress intended. Now, let me step back for a second. This is the power of this education and updates from the Slott group. We have a significant change. This is not the first time when we've been talking about this as a group. I started hearing about it right after the legislation passed last year. Most people who do what we do, planners and advisors, this is not even on their radar. And this is going to start changing, obviously, by January 1st, 2024, these election requirements. So this is when we talk about building your retirement team, you have to make sure you have qualified people. When you're talking about distributions from retirement plans and IRA accounts, it's not the same as those folks who very effectively often work to grow your accounts with investment strategies. Investment strategies are very, very important. We spent a lot of time talking about it last week, but distributions and different elections and selections from your IRAs and 401k plans. These are the critical items that can have a significant impact on your retirement plan, the effectiveness, the efficiency, the longevity of your retirement plan. So under the new rules now in place, Ian continues to write. So I am right. If you're following me along with me here, I am right here. Hopefully you can see my cursor. Under the new rules in place, spouse beneficiaries generally have two options. One is to do a spousal rollover of the deceased owner's IRA to the spouse's own IRA. That usually isn't recommended until age 59 and a half because the survivor will be subject to the 10% early distribution penalty if she taps into the funds before then. The second option is to remain an IRA beneficiary. That avoids a 10% penalty and allows RMDs, that's required minimum distributions for you who may not know that, to be delayed until the deceased IRA owner would have reached his or her RMD required beginning date, generally today age 73. No election is required for this section option. Starting next year, the spousal rollover is still on the table as the best option for spouse beneficiaries age 59 and a half, but things go off the rails for a spouse beneficiary who doesn't want to do the rollover because, for example, if she's younger than 59 and a half or worried about the 10% penalty. That person will have to make an actual election if she wants to have RMDs delayed until the deceased spouse would have been 73. Making that election will allow the spouse beneficiary to use the IRS Uniform Lifetime Table. You can download that from our website. Go to attleboroughwealth.com. Go to the resources and choose the slot corner. And all the way down at the bottom of the page is where you can download tax forms. We'll put a link in the description. So making that election will allow the spouse beneficiary to use IRS Uniform Lifetime Table rather than a single lifetime table, which is typically what an inherited IRA person uses to calculate their RMDs. That's a good thing since it result in lower RMDs. But when RMDs start, the spouse beneficiary must apply that table by using not her own age, his or her own age, but the age the deceased owner would have reached had he or she lived. That's also a good thing if the surviving spouse inherits from a younger IRA owner. Not a common situation, though. It's a bad thing if the spouse beneficiary inherits from an older owner, the more common situation. The alternative for a surviving spouse younger than 59 and a half, let me move this up a little bit. The alternative for a surviving spouse younger than 59 and a half who remains a beneficiary is not to make the election. But not making the election means the spouse beneficiary must start taking RMDs the year after the IRA owner died, like non-spouse beneficiaries. Another bad outcome. The bottom line is that whether intended by Congress or not, Section 327 is a mess that needs to be fixed. January 1st, 2024 is right around the corner and hardly anyone seems to be paying attention. It's imperative that Congress or the IRS act as soon as possible. So get this on your radar. If you have questions about it, if you think someone you care about or yourself might be in this situation, then reach out to me and we'll work through it. Okay. We're going to talk about the markets. Boy, the markets, huh? So last week, if you listened to this webinar last week, you would have heard me talk about consumers going off a cliff. Wells Fargo reporting that a Wells Fargo analyst saying that we're looking at a very challenging real estate market. We're talking about the Fed and when the Fed is going to, whether they were going to pause. Everybody kind of knew that they were going to pause increasing interest rates, but if they're going to pick that up again and what that means, and is it a positive for the market? Is it a negative for the market? And it was, and I said, I'm very concerned about the markets. We've had this kind of euphoria in the markets in 2023. And if you would have asked anyone going into 2023 what they thought the markets were going to do, very, very few, if any, would have said we'd be up as significant as we were prior to September. And that has been a challenging market since September, going even into very close to the end of October. But then last week, something happened, and there's a couple thoughts behind it, but they just started knocking the cover off the ball. So the Dow Jones Industrial Average was up 5.07% for the week. The S&P 500 was up 5.88% for the week. The NASDAQ was up 6.62%. The MSCI World Index, excluding the U.S., was up 4.72. The emerging markets were up 3.12. So really, really great returns really across the board. Even the bond market was up almost 2%. These are big gains in 1 week, and they're some of the biggest gains we've seen in a long time. So again, as I said in the opening here, it really is a very good testimonial of why you shouldn't try to time the markets, and why you should have your plan and your strategy based on what your needs are, so that you can have short-term investments and you can have long-term investments, and you can take advantage of these good positive swings in the markets, but make sure your short-term goals are taken care of. So it's very, very important. Okay, so what are some of the analysts saying? I'm going to come back to what the Wall Street Journal are saying. I'm going to talk about this analyst report from Empower. So this is a long document, and if you just Google it, you can probably get. I don't recall what it's called, but it's probably Empower's Market Update, and it came out yesterday. But there's a lot of information. But I'm going to just talk about some of the highlighted spots that I have here. So this is what they said about here's what happened with the Fed. So this is what they say. Here's what happened. On Wednesday, Jerome Powell's Fed surprised exactly no one when it left rates alone for a second consecutive meeting of the Fed's rate-setting committee. In the post-decision press conference, Powell pointed out a few things that the markets had already guessed would serve as justifications for that action, such as signs that inflation is a little less awful than it was a year ago, that supply chains had come a long way toward healing themselves, and the labor market seems to be stabilizing. Also on the list was a tightening of financial conditions. So I highlighted and underlined that. So this tightening of financial conditions, which is really just the Fed's way of pointing out that the equity markets, that's the stock markets, have been selling off recently, and interest rates have been rising on their own accord, even without any help from the Fed. So they're saying that the Fed kind of pulled back and said, okay, the markets seem to be reacting the way we want them to react with these pressures of higher interest rates. So said a little differently, they go on to write, markets are starting to do some of the Fed's heavy lifting all by themselves. Okay, so far so good, they say. I'm going to jump forward a little bit. About midway through the press conference, Powell used the phrase, "we're close to the end," apparently referring to the idea that the 18-month tightening cycle, raising interest rates, that's what they're talking about, that took the federal funds rates from effectively zero to a current range of 5.25 to 5.50 was closer to over. Stock markets seemed to take that to heart and promptly piled on a few more points. But here's the thing, they go on to write. If I heard it right, this analyst writes, again, no guarantees. What Powell seemed to be saying was that the market believes we're close to the end, not necessarily that the Fed itself does. And as Powell again went to great pains to point out, his Fed is still relying very much on economic data for its cues. So it's quite possible that investors took Powell's remark almost entirely out of context and rallied on a description of their own marginally suspect behavior rather than actual guidance regarding where Fed policy may tack from here. If so, that puts last week's rally in something of a different light. So they're saying maybe investors misheard Chairman Powell and they're reacting inappropriately, but we won't know until we look back on this in a year or two. Still part of the Fed's narrative are things like getting inflation back to 2% will likely require a period of below-trend growth and softening of labor market conditions. Data dependence they talked about. And then they went on to talk about other options of why this may occur. And I thought this was interesting. Let's see if we're there. Yeah, I'll just read this to you. At first blush, that's probably good news given Powell's comments and about needing to see more balance in the labor market. They're talking about the labor markets. I'm sorry, the just prior to that. So let me see here. The labor market data, and we're going to talk about that a little bit in the Wall Street Journal article, really small, was at least somewhat Fed-friendly. For example, non-farm payrolls expanded by $150,000 in September, only the third time below $200,000. Did I say dollars? 150,000 jobs in September, only the third time below 200,000 since the COVID pandemic ended, and about 30,000 less than the economists expected. At first blush, that's probably good news given Powell's comments about needing to see more balance in the labor market before the Fed gets comfortable continuing its pause. So what they're saying in that is that we're starting to see a reduction and softening in the labor market. Then that's more evidence that the Fed could pause. All right, so I'm not going to read all that. What they went on to talk about, though, that was that the Treasury had went ahead and said that we're going to be borrowing less than we anticipated. So they go on to write, it looked like Uncle Sam might be in a little better position to spend out the current cash flow than they originally feared. Instead of putting an expected $850 billion plus on the they say the Amex, but the federal credit card during the December quarter. So this is just this quarter. It looks like the figure will be closer to $776 billion. So they go on to write that relief surrounding the revelation was probably one of the reasons that U.S. Treasuries had one of their best weeks in a long time, and that could also help fuel the stock market. So I thought that was really interesting. I hope that made sense. The person or group who writes this analyst report is always very interesting to me. So the Wall Street Journal had a good piece about why the labor market is softening. So the question was, companies have slowed their hiring and the number of people who voluntarily quit their jobs has declined since early last year, suggesting that the labor market is starting to freeze up. There was discussion about that, and they were what does that mean for employers is the question. So the answer was bosses have a new labor challenge. Hardly anyone is quitting. Turnover has fallen so significantly at some major employers that companies are now over budget on a number of teams, forcing executives to consider whether to cut additional workers as the year-end approaches or to postpone projects. This is all, of course, a massive reversal from the past few years when so many people sought out new jobs and better pay that the era became known as the Great Resignation. What's changed? Many white-collar workers, sensing that the job market is softening, have decided to stay put in their current roles. The latest twist in the labor market is catching some executives by surprise. Companies track attrition closely, and many leaders have predicted that at this point in the year, lots of employees would have resigned. It just didn't happen. So that was an interesting take, I thought, also from the Wall Street Journal. All right, well, here is our next segment. So I'm going to share my screen again. This is our Financial 15 segment. So this is, if you're just joining us for this portion of this webinar, this is the last 15 minutes or so of our weekly webinar. In the first 15 minutes or so, we talk about updates from the Slott group. And then we move into our market updates, and we talked about what the markets did last week and some analyst reports about what we think might be causing the response in the market over the past week and what to look out for going forward. And let me just say, I'll just say again, from the investment point of view, I spent a lot of time on investments last week. If you want to go back and look at that video from last week. And as a reminder, folks, we have this longer format of the weekly webinar, which can run 45 minutes to an hour. And then we also have the Financial 15, which is the last 15 minutes or so of the broadcast. But we break that down also in playlists. And if it's longer, then if we get close to 15 minutes, we'll leave that usually intact. Sometimes we'll break it down to a couple 7.5s if we can find a good place. But we want to break these up into easily listenable, if that's a word, segment, so you can understand it, because Financial 15 is not always 15 minutes, if I'm being honest. But if you're just joining us for the Financial 15, make sure that you hit the subscribe, like, and notification button, and you might want to go back and listen to the weekly webinar. So let's talk about year-end planning. And the first item I have on here is, why is it important? I don't know why it has a blue line surrounding it, but now it's gone. So why is it important? And I get most of my webinar ideas from you folks, clients who I'm talking to, or people who write in with questions. And we're going through our financial year-end planning. So we started sending out emails in early September with this year-end planning document that I'm going to share with you that asks just some really simple questions. And I had someone ask me, well, why is this important? So I explained that. I explained that to this person, why it's important to do this year-end planning, and I want to thank them. I said, okay, well, now the good news is that not only do you know why this is so important, but you've also given me a great webinar topic. So I thought this was a really good time here. It is November 7th to talk about year-end planning and why is it important. So I just wrote this down. It identifies actions you may want or need to take before the close of the year. Really simple. Why is this important? Because once the calendar turns from December 31st to January 1st, there are many things you can't go back and do. There are some things that you can do for prior years, and we're going to talk about that, or the prior year. But there are many, many, many things that you can't undo or do that maybe you could have done if you would have taken a look at it. Back to those critical items. There are critical items in your retirement plan that maybe if you knew myths and misconceptions and on these critical items, that maybe if you would have known in the past, you would have done things differently. But we have these windows of opportunity to do things now. And this is just like the year-end planning is the same thing. If you're not paying attention to these things, or if nobody's bringing it to your attention, if you don't work with Attleboro Wealth Management, is your current financial advisor sending you a year-end planning document? Are they talking to you about things to do at the year? I hope they are. If not, you should probably be having a conversation with somebody else. But these are critical items that you may look back on in early 2024 or late into sometime in 2024 and say, darn, if I just would have thought about that, maybe I would have done things differently and they would have had a big impact. So why is it important? It identifies actions you may want or need to take before the close of the tax year. And the close of the tax year, folks, it's technically December 31st, close of the year, of course. But there's so much, there's so many things that need to be done before that you just may not be able to get done by December 31st if you wait until the end. We're going to talk about Roth conversions here. Our deadline for Roth conversions in our office here is December 15th, because by December 15th, we're confident that we can get a response from the custodians and that those conversions are going to get done. After that, everybody says it's best efforts. They might say, your Vanguard, your Fidelity, your Charles Schwab might say, oh, we can do Roth conversions right up to the deadline, 12/31 if it's a business day. Don't trust that. Don't count on that. What if something happens? What if you need an initial, a signature? What if there's something that just doesn't get it done? Okay, so why is it important? Identify actions you may want or need to take before the close of the year. Information to review. So what do you want to review? I wrote here capital gains and losses. So information to review, capital gains and losses. So what are capital gains and losses? In your investment accounts that are non-IRA accounts, so not Roth IRAs, traditional IRAs, or retirement plans, we're talking about anything. Remember our buckets, right? Taxable, tax deferred, and tax-free or tax advantaged. So we're talking about anything in this taxable bucket. Your tax deferred bucket, you're going to have gains and losses in that tax deferred bucket and in this tax-free bucket, but you're not taxed until you take distributions out of the tax deferred bucket, and hopefully you're not taxed at all when you take distributions out of your tax advantage or tax-free bucket. But this taxable bucket, losses and gains, sometimes uncontrollable gains. We're going to talk about that a little bit. But these are all things that come out of this taxable bucket. So you should be aware of your capital gains and losses, and they can be short-term gains or they can be long-term gains. And obviously short-term capital gains are taxed as ordinary income, and that's just like you earned it. The ordinary income tax flows into that marginal, into that graduated cylinder, and it's calculated on the margin, on your marginal tax rate, and that's how that works. And long-term capital gains has preferable rates, so it can be 0, 15, or 20%, with a potential 3.8% surcharge. So you got to be aware of where you fall on those capital gains rates, because short-term gains, long-term gains are taxed differently, and losses you can use to offset those gains. So if you look at your taxable investment accounts, your brokerage accounts, and you see, geez, I've got $50,000 in gains that I took out money for whatever, and I've got these gains of $50,000. Well, are there some losses in that account that you can harvest? We're going to talk about that to offset those gains, either for this year or next year. So you should be reviewing your capital gains and losses. So other information from the sheet. So I'm going to share with you my year-end planning sheet. So if you're a client, you know this well, but really simple information. Income for the year. Any bonuses. Some people forget about those bonuses, and sometimes they're big. When they're calculating their income, they say, oh, geez, I didn't realize that my bonus income was going to be captured in my marginal tax bracket, and this might affect my Roth conversions, my IRMA strategies. I didn't even have IRMA on here. I did a whole video webinar on IRMA that you should watch. Other income for the year. Do you have other income, some consulting income, rental income? Do you have an Airbnb? Do you have, is just that other income? Withdrawals from your retirement accounts. Yes, you'd be surprised how many people forget this. I once had a client who called me, and she was very upset with me. And she said, Mark, I just looked at my IRA, and it's down. It's down significantly. It's down $30,000 in a short period of time, and I don't know why it's down. And I'm not very happy. And I said, well, do you remember that we, and maybe it wasn't her retirement account, but it still tracks. But I said, do you remember you bought a car and you wanted to take $30,000 out of your account? And she said, oh my gosh, I'm so embarrassed. I completely forgot about that. And that happens, folks. I know it may seem like, who would forget about that? But people forget about things all the time, and it's normal, and it happens. So withdrawals from retirement accounts, withdrawals from other accounts, even your taxable accounts, could create capital gains. So you've got to look at that. If you go into your online access at any custodian, Schwab, TD Ameritrade, well, they're both the same now, Schwab, TD Ameritrade, Vanguard, Fidelity, you should be able to see your gains and losses. And withdrawals from retirement accounts. And we've had people say, over and over again say they forget, oh, geez, I took $50,000, $10,000, $20,000 out of the retirement account. So this gives you a chance to record that, right? I took that $50,000 out of there. And the same for the second person in your household. If you have a second person in your household, you want to review these really simple things: bonuses, withdrawals from retirement accounts, and your estimated gross total income. And then we have other tax events or changes for the year. Here's an example: sale of a home. People don't think about these things. Sale of a home. They're not always. Sometimes you get an exemption or exception for capital gains on the sale of a home. Sometimes you don't. Sometimes it's not your home. It's an investment property, or sometimes you can only take a portion of that exemption. Consulting income, as I said, tax credits. So a big one right now is EV credits. You should be taking a look. Did I do anything this year? Listen, folks, you all know I drive an EV. We just installed we installed a charger last year. We installed another one this year at our office. I for sure, when I already did tell my accountant, hey, we put another EV charger in. I want to take the tax credit for that. Change of employment. That could be more money or less money, whatever your situation is. Go through and kind of check these things off. Any other major changes to your expenses in the past year, that's important. And estimated tax payments. What estimated tax payments have you made for the year? And do you need to decrease that or increase that coming up towards the last estimated tax payment? And we're going to talk about that. So feel free to kind of use this as a checklist. If you're a client, you received either this or you received the link for the digital version of this. But folks, if you need, and I hope I didn't cut any of this off, I was trying to stay to the right of the screen. But if you want to receive this, just send us an email. You know where to go. That's questions@attleborowealth.com. Questions@attleborowealth.com, and ask for this year-end planning form. I'm happy to share it with you. It'll help you go through it. That's what I want. So there are some of the other questions. So what do you need this information for? Consideration. Well, Roth conversions. Folks, you cannot do 2023 Roth conversions in 2024. You can't do it. I hear this all the time. There's a lot of confusion because you can do Roth contributions in 2024, but you can't do Roth conversions in 2024 for 2023. So you have a window that's closing on these Roth conversions, and you need this information to calculate those conversions. Because for most people, if this goes 10, these are our marginal tax rates, 10, 12, see, I'm doing it, 10, 12, 22, 24, 32, 35, and 37. For most people, we're staying right here in these marginal tax brackets. Some people, yes, we have to go up over to here for that to be effective for them. But most people are staying right here in the 22 to 24% marginal tax rate. And if you're just listening to me, I just drew a graduated cylinder, what we like to call a graduated cylinder of our tax rates. And I listed out the marginal tax rates, and I circled 22 and 24%. But if you're not calculating correctly your income or IRA distributions, if you forgot about those IRA distributions of $50,000, for example, that could take you up into the 32% bracket. Is it the end of the world? No. Is it maybe inefficient for your plan? It might be. So you'd want to know exactly what the effect is going to be, because you can't go back and undo it. Remember, we used to be able to do, and I had a question about this recently. Someone said, well, I can recharacterize my Roth conversion. Well, you could have prior to 2017, but you can't do it anymore. So unless you have ability to jump, go back in the Wayback Machine and go back to 2017 and recharacterize that Roth conversion. I know I'm being a little cheeky here, but you can't do it anymore. You can recharacterize a Roth contribution, but you can't recharacterize a Roth conversion anymore. Recharacterization, what is that? It's an undo. We used to have until October 15th of the year following the year we did a conversion, but that doesn't exist anymore. That law was erased and taken away. That ability was erased and taken away with the Tax Cuts and Jobs Act. So no, you cannot do it. Yeah, so this information helps you plan for Roth conversion. It also helps you plan for estimated taxes, over or under, right? Did I pay too much in estimated taxes, or did I pay not enough in estimated taxes? This is why you need a good CPA on your team too, good tax planner like we are, a good tax preparer like a good CPA is. And the last person you should have is a good attorney. So I have got a whole video about your team. I'll try to remember to put that in the description as well. But so the estimated taxes are due on January 16th of 2024. That changes. It's January 15th usually, unless it falls on a holiday or a weekend. But this coming year in 2024, the estimated taxes for the end of the quarter 2023 are due on January 16th of 2024. So dial it in, get it as close as you can. Work with your tax preparer on that one, on your estimated taxes. How about 401k contributions? You might want to max out your contributions. If you're over 50, that's $30,000. Hopefully you're maxing them out in Roth contributions in your 401k or 403b plan. And for any retirement plans, because you also can't go back and contribute to your 401k after the close of the year. What you could do, if you find yourself short, you could say, I want the rest of my payroll to be contributed to my 401k or my retirement plan, my company retirement plan, so I can get up to the maximum contribution level or as close as possible. But you need to know what your contribution levels have been thus far. HSAs have some flexibility. We won't go into that. Tax loss harvesting. So I talked about that a little bit when I talked about capital gains and capital losses. But you'll see I have some asterisks here because I'm going to do a whole webinar, whole Financial 15 dedicated to tax loss harvesting next week. What is tax loss harvesting? Tax loss harvesting is when you go into your taxable bucket funds, so your brokerage accounts, etc., not IRAs, and you sell positions at a loss to be able to book that loss. So you can either offset any gains you have for the year, and yes, you've got to follow up, long-term gains, offset long-term long-term losses offset long-term gains, short-term losses offset short-term gains first, and then they can cancel each other out. Or you can carry forward $3,000 a year of unused losses, or save them, bank them. Loss carry forwards, they're called, to use in future years. So if you're able to, let's just say, I'm using the example of $50,000. What if you had $50,000 in losses that you could realize? You have to sell those positions to realize them and not repurchase those positions for at least 30 days. Then you can either use those losses to offset gains you already have, or book those losses for future use. So I know that gets complicated, and that's why we're going to just talk about only that during the Financial 15 of next week. But tax loss harvesting is something you also cannot do after the close of the year. So take a look. If you don't know what your capital gains are, if you don't know, what really your capital gains, you're going to have to, you won't know if it's going to benefit you to do this tax loss harvesting. And frankly, it may not benefit you in 2023, but it may benefit you in 2024, 2025. So it may make sense to still do it, but you can't do it for 2023 tax year once the tax year closes. So you want to review that. I'm not saying that you're definitely going to want to do it. You want to review it. I have mutual funds listed here. Why is that? Because it is really hard to identify potential gains that you're going to get, that are going to get distributed to you from your mutual funds until it's too late. What you have to do is you have to find the links for the fund companies, go in, and at this point, most companies, here we are, November 7th, most companies have their projected gains for the year, so you can go in and see what the projected gains are. This is something that hit a lot of people right over the head last year. A very, very big Fidelity fund reported capital gains, significant capital gains. This fund was designed to be in retirement accounts, so they were not tax sensitive, but many people held it outside of their retirement accounts because it had what people thought was good performance, and it was a relatively easy fund to purchase and identify. And people did that outside of their retirement accounts, and this fund reported a lot of capital gains, even though the fund value was down for the year. So that is a real kick in the behind, right? When your fund is down for the year and you have to pay capital gains, tax on capital gains coming out of the fund. But that happened a lot last year. So get a good idea of what your mutual funds, the mutual funds that you own, what the projected capital gains distributions are going to be. Dividends as well, right? You want to count up those dividends. I've only talked about capital gains, but we want to count up those dividends. And then I have IRA and Roth IRA contributions, again with a little asterisk. And I have the asterisk there because that is one thing that you can contribute. You can keep your contributions on track till the end of the year, but you have until the tax filing deadline of the following year, so until 2024, the tax filing deadline of 2024, to contribute to your IRA or Roth IRA if you qualify. So that area there, we have some flexibility with. Okay. So folks, that is year-end planning. So we went over a lot of information today in the, certainly in the weekly webinar. I'm just bringing this in so you can see everything we talked about. So we talked about a lot during the weekly webinar, and we talked about the reason for year-end planning. Why is it important? Identify actions you may want or need to take before the close of the tax year. Information to review. You can ask for our form if you don't already have it. This form here, this year-end planning form, it's very, very simple. All it's doing is sparking the question, right? Sparking the memory. I do it too. My accountant sent me a whole list of things. What's this payee for? What is this person for? I don't see any record of this. What is this? I'm going through it too. I do my own year-end planning. Capital gains and losses we talked about. What are the considerations? Roth conversions, estimated taxes, 401k contributions, tax loss harvesting. We're going to talk more about that in depth and more in depth next week. Mutual funds and IRA and Roth IRA contributions. And that's it for today. If you have questions, you can reach out to me at questions@attleborowealth.com. If you want to schedule a time with me to review your situation, you can do so by reaching out to us at questions@attleborowealth.com. If you want to download this year-end planning form, if you want that year-end planning form, it is not available on our website. You have to reach out to us at questions@attleborowealth.com. If you want to download other information or view past weekly webinars, you can do so at our YouTube channel or go to attleborowealth.com. And our YouTube channel is simply Attleboro Wealth. I think it's actually Attleboro Wealth Management, but I'm sure you'll find it under Attleboro Wealth. And that's it for today. I hope this was helpful. I hope you have a great week. If you're in the southeastern Pennsylvania area, it's supposed to be a beautiful week. So I hope you enjoy the outdoors. And that is all, folks. Have a great week, and we'll see you next week. Take care.